Moving forward, I would like to invite our fourth team for the day, Nile Street Analysis, to the stage.
Good afternoon, everyone. Now, imagine a company that doesn't just move goods, but move the economy as a whole. Every day it connects all 6 US-Mexico gateways, major ports, and inland hubs, keeping trade flowing across North America. The company is Union Pacific Corporation, and today we are recommending a buy. Currently, the stock is trading at $213.66 US, and our target price is $272, giving investors an 18% upside. Before we move further, we are Nile Street Analysts. I'm Hanit, Yokal, and Manuel. Today, we are here to explain why Union Pacific is a good investment opportunity. Our recommendation is based on 3 theses. The first one is Union Pacific has highly attractive free cash flow, which is driven by margin. And secondly, it has robust shareholders' return. And finally, Union Pacific have high quality, scalable growth. Looking at the company's overview, as you can see on the map, Union Pacific covers 23 Western US states. And in 2024, it has generated $24 billion in revenue. From that, $22 billion come from freight revenue. And it has served more than 10,000 customers across 3 major segments: the bulk, the industry, and the premium. Union Pacific also has operational efficiency. Looking at its injury risk, it's lower than its competitors, and the volume it has delivered in 2024 is higher than its competitors. So this operational efficiency, together with different segments, has enabled Union Pacific to capture 39% of the market share related to its peer. Now Yokal will walk you through the historical performance.
When it comes to about historical performance, the graph shows that the year-to-date performance of Union Pacific through January to December, as you see, the company is growing 1.15% from the beginning. This indicates that the company has modest growth over the year. And when you see the broken line, the company's current price is 230.66 per share. And when you see from 210 up to 250, it ranges the price. This also indicates that the company has a moderate level of volatility. When we see the dots, the orange dots shows that significant events happen. For example, in June, there was a conference, material and industrial conference. After this conference, the company increased by 0.5%. When we see key drivers for differentiation, the first one is consumer spending and import-export volumes and freight mix shifts. This includes intermodals, bulk and industrial. The third one is fuel price volatility. The rail is cost-effective and cheaper than truck. And the fourth one is regulatory environments. When we see the pie chart, it indicates that the company's revenue, the first one is freight rail transport. This is the backbone of the company and it covers 68%. The second one is intermodal, it covers 70%. And the third one is industrial service. From this, it covers 10%. And the rest 5% comes from leasing and access fees. When we say about strength position through merger, the company Union Pacific proposed $85 billion for Norfolk Southern using cash and stock. And when you see the yellow one, it's Union Pacific coverage, and the black one is Norfolk Southern coverage. When it merges, it enhances geographical location and also it minimizes transit time. When we say about the portrait 5 forces, the first one is rate of new entrants. It's very low because of infrastructure and it requires high capital. Bargaining power of buyer, it's moderate, and industrial rivalry is moderate to high. Rate of substitute, it's low, and bargaining power of supplier, it's moderate to low to moderate. And when we see about the valuation, as you see, the football field chart indicates that the company is undervalued. Aman will continue.
So now we will look at the investment thesis. So based on the first thing that we looked at on the investment thesis was the free cash flow of the company. The company have a very good free cash flow. It has been growing year over year. This shows that the company have a very good financial flexibility. And the second thing that we looked at was the returns for investors. The company have been paying dividend for a century now, and they have a consistent shareholder share buybacks. So, and the last thing that we looked on the investment thesis was the growth of the company. The company have been investing in a lot of infrastructure to expand their market reach. Then, overall, this investment thesis shows us that the company have a very good free cash flow, and at the same time, very good return for investors. Then we try to compare the value, the company with its competitors across different metrics. The first one was the EBIT margin. We found it to be 41%, which is extremely high compared with its competitors, which shows the company's operational efficiency. And the second thing we looked at was the ROE, which is ROI, which is the return on investment. It's around 40%. It shows that the company is giving a lot of profit. And then the last thing we looked at was the ROIC, which is return on investment capital. It's around 13%. Still, when we compare that metric, it's above the market average, which shows the company is reinvesting. Then we tried to value the company based on the cash flow it will generate in the future. So we considered three scenarios: the base case, which is the normal case, the bullish case, and the bearish case. So based on these scenarios, we found the business to be undervalued. So for the normal case, we found 18% upside, and for the bullish case, we found 35% upside. Then we looked at the catalysts that will propel the company's growth. So the first one is operational efficiency. The company have been implementing different technologies like the PSR system, which is precision scheduled railroad system, which will improve the company's operational efficiency. And the second one is their capital expenditure plan. They have a 3.5 billion capital expenditure plan over the next few years. This will expand the market reach and their infrastructure. So the last catalyst that we looked at is the merger between the Union Pacific and Norfolk. We want to put a big emphasis on this merger. So this merger will create the first transcontinental railroad system in America, and this will give Union Pacific a price-setting power and a big, wider market reach, and it will continue.
Okay, like in other large operation, Union Pacific face some risks. The first one is decline in international trade due to decline in imports or change in tariffs. To mitigate this, the company is focusing more on domestic trade. And the other is decline in outputs like manufacturing and harvesting. To cope up with, the company is focusing more on stable categories such as chemicals and energies. And the other is higher interest rates or economic downturns, and to cope up with, the company is focusing on pricing strategies and debt management system, as well as maintaining a strong cash flows. The other one is it's a risk according to the competitors, high demand towards trucks, and to cope up with, the company is focusing more, is partnering with trucks. Therefore, we are recommending a buy on Union Pacific Corporation, and as we have mentioned earlier, it's going under merger with Norfolk. This merger has some specific risk related to operational disruptions, integration challenges, or regulatory challenges, but this merger will unlock a significant potential by increasing the market share, and it will enhance efficiencies. So this merger, coping up with the investment thesis that we have mentioned, will increase the shareholders' return. So we are recommending a buy on Union Pacific Corporation. Thank you.
So can you just break down where the growth comes from? So ignore the merger and talk about the acquisition and talk about the growth of revenues and EBITDA, and then how that changes when you add the merger of Southern in. And then can you talk about the CapEx and why that's important? Because there's obviously a huge amount of CapEx in the cash flow.
Yeah, so we mentioned the CapEx to show the free cash flow because it shows how much they're investing on capitals to expand their business. And the CapEx conversion, also the CapEx to EBITDA, also showed that how much of their earning it should a decline on the CapEx to EBITDA, which means they are saving more cash flows so that they can pay for the dividend equity. So we mentioned the CapEx to show that they have a growth potential. They are investing on expanding their capitals. But the CapEx to EBITDA is declining, which shows that they are keeping more cash flows for their equity and debts.
In terms of the growth, there are three things that we looked at. The first one is operational efficiency. The railroad industry as a whole, they are investing on operational efficiency. They have been implementing a new technology, the PSR system, which will increase their operational efficiency. And the second growth metric that we looked at was the freight growth, the volume that will grow in the future. And this will expand the growth of the company and their network expansion. They have been investing a lot on their network expansion. This will influence the growth of the company.
From your research and from your papers, the company has been consistently paying dividends. But this is a capital-intensive company where there should be significant capex requirement in terms of technology, repair, maintenance. How could the company manage just to do like this? Or is there any plan in the future to reserve some of the dividends for technology changes?
We have mentioned as an investment thesis, our first argument is that it has a high free cash flow. So since it has a strong cash flow, it can manage paying debts as well as investing on capitals to expand its growth. So like our railroad industries, such as Union Pacific, one of their advantages is their cash flow. So it has a strong cash flow, which will enable him to pay dividends as well as expanding by paying by investing on capitals. So our argument is the company will manage this by keeping a strong free cash flows.
My question is, looking at the historical data, the company seems to be in the same position for the last 3 years. And why do you think it's undervalued? Because you mentioned in your presentation, you feel like it's undervalued and you're commanding a higher price. That's one. And the second one on the merger, if it is announced merger, usually the share price should reflect the impact of the merger and the business, right? So has that been reflected? Is that part of your thesis why you're suggesting that it's undervalued? Because investors, if investors feel like it's undervalued, they usually pick up the stock immediately, right? So what makes you feel like the company is undervalued, looking at the historical data and the merger that you're mentioning as well?
I think that we're thinking the business is undervalued because of the macroeconomic impact that it has been facing now, because of the tariffs that has been taking place now. The company's volume has decreased. The market saw this and thought the company won't be able to survive this tariff. So they undervalued the company. But then some negotiations that will happen in the near future will stop these tariffs and increase the volume of the company.
The merger thing, as you can see, we didn't state it as an investment thesis. We are not recommending a buy because of the merger specifically. The merger is a catalyst. We have bring arguments like free cash flows, its strong cash flows, and its history of dividend paid. That's the reason we are recommending a buy. It's not solely because of the mergers that's going on.
Do you expect any disruptions in the industry? Disruptions in terms of new technologies?
Union Pacific is working to, under its new management, they are working to increase their operational efficiencies by reducing operational costs. So they are integrating technologies to keep up with other trucks and other competitors. So they are mitigating it, so the disruption would be reduced because Union Pacific is adapting new technologies to improve its efficiency. And for a long distance transportation, road is a good option because it's very efficient. So it will integrate the technology. Technology will enable him to increase its efficiency rather than disturbing the whole business.
Okay. And also, you said it's major moat. What's the major moat for this company?
Economies of scale.
Okay.
And it's dominant in the market. It has, as I have mentioned, it has covered 23 Western US states. So it has covered a large geographical area. That's also its motto, and it's working on diversified segments like bulk, industry, and premium. So this thing is its competitive advantage. And the market is also oligopoly. There are only 6 railroads in Class 1 in the US. So this is also its strong moat.
Okay, if I have a minute, just one question I have for you. Usually, companies like this that work on these types of businesses, they usually have labor union issues. Have you guys looked into it? Do you have any information on that?
They have been implementing a new technique. They are sending out a one-man crew, so they're paying a good amount of money for one person to do a job of 3 people. So the people won't unionize and affect the work of the company.
Just elaborating on the regulatory issues. I mean, how many rail companies is right for the US? So there's 6, 5 at the moment, going to be 4, 5. What's the right number for that market? What's the right number of rail companies for the US?
At the moment, we have about 9 companies, top 9 companies. So we found 5 public companies, private public companies. So in terms of regulations, if you are asking about the merger, I think the current leadership of America is we think it's much in favor of this merger.
Is this the beginning of a consolidation process?
We think so.
Thank you so much to our fourth team.